James Carlisle is Managing Director of R3CEV, which is a consortium of banks from around the world, which looks at ways of collaborating on use of distributive ledgers, which, as everybody knows, is the technology behind Bitcoin. So, James, perhaps I could start with you.
Yep.
Bitcoin, distributive ledgers, I mean, this is, in a way, the ultimate example of collaboration between different players in finance, isn't it?
Yes, it is. And I think the promise of distributed ledgers and blockchain is that two parties who may have different economic interests, two organizations that are dealing with each other, know that what they see is what the other side sees. But in order to build a system that presents this guarantee of truth to them, they need to do a lot of collaboration in advance. And that is really what R3 is all about. R3 was founded just over a year ago and has more than 70 of the world's largest banks as members, looking at technology behind distributed ledgers, but also the use cases as well, and evaluating those together. And it's obviously possible for organizations to evaluate technology by themselves, behind closed doors. But the particular promise of these distributed ledgers means that they demand collaboration. And if you're going to experiment with them, you have to do that in a collaborative way.
Right. Pete Behrens, who's Chief Operating Officer of RateSetter, which is one of Britain's leading peer-to-peer lenders. And peer-to-peer lending, I mean, that relies really on collaboration, cooperation with established players in the market to exist at all. Is that right?
Yes, Jeremy. I think, look, we're completely dependent on the bank's plumbing. So, when somebody puts money into RateSetter to lend it to somebody else, it comes from their NatWest account, ends up in our Barclays account, and ends up in our customer's Santander account. So we're relying on the banking system. We're not eating the bank's lunch in that way.
Right.
Well, I think that the collaboration piece is interesting because I think that certainly in the peer-to-peer space, there's an awful lot of talk about how collaborating with the banks is terribly important, and particularly over in the States, where you've got a much more fragmented banking system, but potentially larger peer-to-peer lenders who are a bit larger in terms of volumes than we are in this country. The banks are looking at peer-to-peer platforms as a great opportunity to find distribution and find means of putting their money to work. And indeed, in this country, one of our competitors takes deposits from Zopa, which it then, not from Zopa, that's who it is, it takes deposits from Metro, which it then on-lends. Our view, slightly contrarianly, is we're trying to build our own infrastructure, and what we're really all about is opening up the asset class of loans to the retail customer. So it's trying to create a different proposition for, in jargon, the ordinary saver. And therefore, we're not quite so committed to the collaborative route as some of our peers.
I mean, one of your leading competitors, Zopa, announced the other day that it was actually going to become a bank, apply to become a bank, didn't it? Is that a good idea?
I would err towards not...
Join the dark side.
I would err to say no. But I don't really see it as joining the dark side. I think that the reason we do what we do at RateSetter and the reason we think peer-to-peer is a valuable part of the financial services infrastructure is that it is a different thing. And what we're basically doing is we're saying to our customers, you take some risk, and in exchange for taking that risk, we will pay you more. But by the same token, we're required to put up a great deal less equity because a bank is required to be completely safe at all times. So that requires an awful lot of equity to protect their customers' deposits. We don't need to put up that much equity to protect our customers. So our argument here would be that we can give a better return to the consumer and a better return to the shareholder, a better ROE to the shareholder. If you can deliver both of those things, that has to make for a really compelling alternative to the current existing things. I'm not saying it's going to replace it, but it is definitely an alternative that has some legs in it. I don't believe that trying to be somebody doing both those things is the route to success. I think you've got to concentrate on what you do and do it right. Trying to do two things is a recipe for, I won't say a disaster about my competitor, but not necessarily the answer.
When most people from outside the industry think of FinTech, they think of thrusting young entrepreneurs determined to bring down established players, transform the industry in a disruptive way, and the way the likes of Amazon has done to retail and Uber is doing to taxi hailing, and so on and so forth. But of course that's not right about finance, because all finance requires a very high degree of collaboration. Every transaction will go through a number of different players. Every party has to in some way collaborate in order to make finance work at all. It works on trust and collaboration. So Lubena Manji, I mean, you're head of Rise and Open Innovation at Barclays, and you're one of the pioneers in having an incubator within a major established player. I mean, how is that working out for Barclays?
It's early days. We've been running it for 2 years, but I mean, we started it off because we recognised that the pace at which financial services are changing, whether that's technological change, whether that's regulatory change, or what customers are expecting of financial services, we didn't think that we as a bank alone can develop fast enough to keep up with the pace of change. And so we created Rise as sort of almost a platform where we can integrate and collaborate with startups and sort of work with them and co-create with them and take our business challenges and work with startups to help solve those within Barclays. So we do some of it ourselves, we do some of it by buying in innovation, but for the most part we're using this as a way to test out new ideas, new technologies with startups and kind of try and create a sort of symbiotic relationship where we can get their disruption and their agility back into the bank, and hopefully we can give them data and become their first customer and give them the opportunity to scale.
Yeah. So they get funding as well as a potentially very large customer out of it, don't they?
We don't invest in them.
You don't?
No. So it's mostly we have contracts with them.
Yeah.
And become their customers, yes.
And what sort of things are you looking for in Barclays? What sort of innovations, what type of technologies are you looking at in particular?
So, well, almost everything really. So, as I said, the main thing is that we go to our businesses, whether it's the retail business, whether it's the investment bank, and kind of say, well, what kind of challenges are you coming up against? Let's see if we can find you startups that can help you solve for them. But the kind of things that we're looking at is, what are the new things happening in blockchain or artificial intelligence, Internet of Things, data, cybersecurity. All of those things are important to us, and we needed to sort of increase the pace of the innovation that we have within the bank.
Right. Now, the payment system is, I suppose, the ultimate gatekeeper to transactions in the financial space. And we're lucky to have with us today Hannah Nixon, who is Managing Director of the Payment Systems Regulator. Loosely, am I right, attached to the FCA? You certainly occupy the same building, but you are separate, are you?
We are a separate regulator. We have our own powers and our own duties. I think we're here fundamentally to drive competition and innovation in payment systems to the benefit of consumers and all users. Now, actually, if you think why are we here in the first place, and particularly why are we here as a regulator in the UK with the strongest powers of any regulator. So we've been in operation about 18 months now.
Right.
So still reasonably new regulator. As I say, we have the strongest powers of any regulator, which I think is interesting. And I think it just reflects that over a period of probably 15, 20 years, there had been frustration that payment systems were seen as getting in the way of innovation, that they were slow to innovate, particularly where you need collaboration, and we know you need lots of collaboration in the payment space. And so we were set up really to crack that and make sure it's not just the incumbents that are able to play in this space, but we're really opening it up to a number of players.
Yeah. Because the payment system is thought of as the ultimate closed shop, isn't it? And if you can crack that, you've kind of cracked access to the money system, the clearing system in general. So what progress do you think you're making?
So I think we're making really good progress, actually. And you're right, I think it was seen as a closed shop in that it was basically the big incumbent banks that owned and controlled each part of the payment system. We've been focusing on three key things since we were set up 18 months ago. First is to really look hard at the industry structure and see if it's a problem that the big banks own and control everything. The answer to that we think is yes, which is why we have proposals on the table for the banks to divest their interest in the payments infrastructure and to open it up to competition. We've been focusing heavily on improving access to payment systems. So whether you're a new challenger bank or a new payment system provider, you can get the access you need to the payment systems quickly and efficiently and on terms that actually suits your business model. And third, we've been focusing on really speeding up the pace of innovation where you need collaboration. And actually, today is a great day to be talking about this because this morning we launched the Payment Strategy Forum's latest new strategy, which is really talking about how we move UK payments into the next sort of generation. Lots of interesting things there about new functionality for consumers, so more control, more flexibility, but also really opening this payment system up to competition. And our vision is that we just get as much competition at all elements in the supply chain as possible.
Right. So the payment system is actually owned by the major banks at the moment, is that right? It's they have shareholdings in it, as it were.
So today the infrastructure is provided by a company that is owned by the big banks.
Right.
And we have a proposal on the table. Firstly, the banks have to divest that ownership. And secondly, that the provision of that infrastructure has to go out to competition periodically. And that, the idea of that is to really drive new ideas, new innovation, new functionality into the payment system.
And just one more question on the nature of the payment system. Is it right that that it has within it a lot of rather untransparent and a myriad different forms of charges which act both as a source of considerable profit to those who participate in it, and as a kind of barrier to entry?
I'm not sure I'd characterise it as a source of profit to the banks, but I think what is true is because the payment system has evolved over time. It's been built by the incumbent banks. As a result, it is owned and basically controlled by the incumbent banks today. What that's led to is a system that suits them very well. And actually they understand it very well, but if you're a new player coming into that market, it's just very hard to find your way around it, understand what you need to do. And so what we've been focusing on is making sure that actually the onboarding is much faster, so people are helped, new banks are helped to get access to payment systems. The time to connect to faster payments now, for example, has roughly halved from 18 months to 9 months. I'm not saying that's brilliant, but it's certainly a step in the right direction. The cost has come down. We now have aggregator solutions. So I don't think this is a proactive anti-competitive move. Absolutely not. It's more that the systems are built up in a way that means they work for those who have been in the space for a long time. If you're new, it's hard to get in. We're trying to change that.
James, everybody knows about Bitcoin. They understand, most people understand less about the technology that lies behind it. Perhaps you could give some examples of how this technology can be used to everybody's benefit in ordinary finance outside virtual currencies.
Sure. So I suppose I should start with perhaps try and explain what these distributed ledgers or blockchains are in 60 seconds without bamboozling. So essentially it's a database, but it's a database with some very special features. And the first one is that it's distributed. So participants in a network have access to the data. In fact, they hold the data themselves. And then the second attribute is that there are the changes to the data are controlled by code. And the code is sometimes referred to as smart contracts. But essentially, this is business logic encoded as rules. that all the parties, the participants on this network, are obliged to follow and agree to follow. And then the third distinguishing feature is that there is something called immutability. That means it's not possible to rewrite history. And that is really interesting because it allows the fourth attribute, which is the idea of verification. The promise that distributed ledgers are making is that the other party sees exactly the same as I do, even if they're competing with me, that there's something verifiably true. And the key part of the distributed ledger is that any party to a transaction can go in and prove for themselves, because typically the software that runs the ledger is open source, and the transactions are immutable and they're all linked together. So any party can trace the history of transactions and trace the history of data and prove to themselves that it is correct. So now an example of where this is being used. So in fact, Barclays Accelerator helped a startup last year, which is involved in trade finance. And Barclays concluded, I think, the first ever trade finance transaction on a blockchain, distributed ledger. And that involved a number of parties. Obviously, the technology provider, Barclays, as a bank that's very involved in trade finance, and also shippers and other parties, importers and exporters. Now, the key takeaway there is that a typical trade finance paper-based process can often take 4 days. But I understand that this particular transaction went straight through because there's no paper involved in 4 hours.
It's 10 days.
Sorry, 10 days. So there's a real-world example where the technology provides trust without, in this case, having to see sight of signed documentation that historically would have been FedExed or shipped around.
Right, right. This word trust, Lubena, is, I mean, whatever else people think about the established players in banking, we had the financial crisis, obviously, which destroyed a lot of public trust in the banking system and in bankers in general. But people still, on the whole, put a very, very high degree of trust in established banks as far as the privacy of their data is concerned, after just physically looking after their money and making sure it's not stolen from them, and so on and so forth. How important is this? Is this basically going to be how the legacy players manage to survive in this brave new world we're moving into? Is that trust factor still hugely important in banking?
Oh, I absolutely think it is. You know, if you can't trust your bank, then what with your money? But I mean, but a case in point relating to, you know, how we interact with fintechs and the whole open innovation is that, you know, for our accelerator program, we get between 500 and 600 applications for the 10 places on the accelerator. And when we asked them, you know, when we actually first started doing the accelerator, we had no idea, you know, whether people would come. But when you ask them, well, why is it? You know, why do you want to work with Barclays? Why do you want to work with a bank? And quite often what we get back from them is, you know, as a financial technology, you know, startup, we need that trust. And if we are part of your accelerator and you have Barclays backing, it's almost like they get that kind of tick in the box, and sort of almost by association they get their trust, and that's very important to them.
Right, right. One question that, one issue that cropped up in a previous panel, one of the panelists said that open banking really was going to make existing IT platforms in the banking space almost redundant, that they'd almost have to start from scratch and design new systems. Pete, do you share that view that existing IT structures are pretty much should be written off and we should start all over?
I'm lucky enough to say I've never worked in an IT department in a bank, but the people I've spoken to that do say they're quite scary places. And I think that, one of the, this is why businesses like mine have an opportunity, which is that we were able to, and actually the people on the panel before it, they were asked, what would you do differently? And the chap from iZettle, which is a genuinely fantastic business, said, think where you're going. And we were able to do that. And I think our big banks weren't able to do that. They've iterated over hundreds of years, and they've got to where they've got to with, frankly, old and challenging infrastructure. And I think, look, it's got to be the biggest headache on the to-do list of every chief executive within every bank, I'd have thought, because the speed with which younger businesses like ours can iterate to deliver what we think is the right outcome for the customer is fantastic. But whilst it's easy to sit here and be all terribly smug about being FinTech, Barclays app, I'm a Barclays customer, I think Barclays app is literally the most unbelievably good bit of kit ever. So they're not bad at what they do. And if we sit here and all sort of put ourselves in our ivory tower and say the banks are hopeless, we're going to come unstuck very fast.
Yeah, no, I'd like everybody to jump in on that question. Yeah.
So I have had the pleasure or pain of working in a IT department in a bank, and I was involved in a project that had to deliver in 9 months and build a payment processing system for the US operations for the bank. And I had to go live over a weekend and take on, I think on Monday, $250 billion of payments. And I think that the point is, yes, it feels slow. Perhaps these IT departments feel slow and cumbersome, but they absolutely have to get it right, because otherwise there's systemic risk. And they are, as as we know, they're working with IT systems that have evolved over 30 years, perhaps, some of them. And it is very difficult to make that transition. But they have to do it in a very, very careful way, because they cannot afford any failure.
Yes, I mean,